Most people think saving money automatically leads to wealth. And honestly, that sounds reasonable. You work hard, spend less, move money into savings every month, and slowly watch the number grow. It feels responsible, safe, like you're doing everything correctly. But then, something strange happens. Years go by, and financially, your life still feels almost the same. Your savings account grows slowly, but not enough to truly change your future. Meanwhile, you keep hearing about investing, compound growth, index funds, and people whose money seems to grow faster than yours. And eventually, a difficult question starts showing up in your mind. Is saving money actually enough? The answer is interesting, because saving money is extremely important, but by itself, it usually doesn't create long-term wealth. And the reason has less to do with effort and more to do with how money actually grows. My name is Alex, and in this video, we're going to break down the real difference between saving money and building wealth, and how ordinary people slowly transition from one to the other without taking reckless financial risks. Let's start with something most people never think about. Saving and investing are designed to do completely different jobs. Saving is about protection. Investing is about expansion. Your savings account is supposed to protect you from uncertainty, emergencies, unexpected bills, job loss, financial stress. But investing is what gives your money the opportunity to grow faster than inflation over long periods of time. And once you understand that difference, a lot of financial confusion starts making sense. Think about it this way. Imagine two people each have $10,000. One person keeps it sitting in a savings account earning around 1% interest. The other invests it into a diversified index fund, averaging around 8 to 10% annually over long periods. At first, the difference doesn't feel dramatic, but time changes everything. Because wealth is rarely built through huge overnight gains. It's usually built through compounding. And compounding is one of the most powerful financial forces most people completely underestimate. A small annual return doesn't just grow your money once, it grows your future growth too, which means time becomes more important than intensity. This is why people who start investing early often end up dramatically ahead, even if they never earn massive incomes. But if investing is so powerful, why do so many people avoid it? The answer is psychology. Saving feels predictable. Investing feels uncertain. When money sits in savings, the number barely moves. There's comfort in that stability. But investments move constantly. Some days they go up, some days they drop. And emotionally, that can feel uncomfortable, especially for beginners. A lot of people assume successful investors are fearless, but honestly, most long-term investors simply learn how to tolerate temporary uncertainty because they understand something important. Short-term movement is normal. Long-term growth is what matters. Now, this doesn't mean you should immediately invest all your savings. That's usually where beginners make mistakes. The smartest transition happens gradually. Step 1 is building financial stability first. Before investing heavily, having an emergency fund matters a lot, because emergencies are expensive when you're financially unprepared. Car repairs, medical expenses, unexpected job loss. Without savings, those situations often turn into debt, and debt can quietly destroy financial progress. This is why many financial experts recommend keeping several months of essential expenses in cash savings before focusing aggressively on investing. That financial cushion creates emotional stability, and emotional stability helps people stay invested long-term. Step 2 is separating your money mentally. One category is protection money. The other is growth money. Protection money stays safe and accessible. Growth money is allowed to fluctuate because its purpose is long-term expansion. This mental shift changes everything, because many people panic during investing simply because they emotionally treat invested money like emergency money, but they serve different purposes. Step 3 is starting smaller than you think you need to. A lot of beginners delay investing because they believe they need thousands of dollars first. That's simply not true anymore. Many investing platforms allow people to begin with very small amounts. And honestly, the amount matters less in the beginning than the habit itself, because consistent investing changes behavior. You stop seeing money only as something to spend. You begin seeing it as something that can work for you over time. And that mindset shift is incredibly powerful. Now here's where many beginners get distracted.
They think successful investing requires complicated strategies, day trading, constant stock picking, trying to predict the market. But historically, simple long-term investing has outperformed most complicated approaches. That's why so many experienced investors focus on low-cost index funds. Not because it's exciting, but because simplicity often wins long-term. And honestly, this is the part nobody talks about enough. Building wealth is usually boring. It's consistency, patience, automation, long-term thinking, not constant excitement. Imagine planting a tree. The first few years feel slow. Almost nothing seems to happen. But underground, the roots are developing, and eventually, growth becomes much more noticeable. Investing works similarly. The early stages feel small, but over long periods of time, consistency compounds into something much larger. Of course, markets won't always move upwards smoothly. There will be crashes, fear, bad headlines, economic uncertainty. That's normal. But historically, markets have recovered from every major downturn over long periods. And this is why experienced investors focus more on decades than daily headlines. Because short-term volatility is temporary. Long-term discipline is what usually creates wealth. So if you're someone currently focused on saving money, that's not a bad thing at all. In fact, it's an important first step. But eventually, many people realize that protecting money and growing money require different strategies. Savings creates stability. Investing creates long-term opportunity. And learning how to balance both is one of the most important financial skills you can develop. If you enjoyed this video, subscribe for more videos about personal finance, investing, and smarter money habits. And I'm curious about something. Do you currently feel more comfortable saving money or investing money? Let me know in the comments.